more from a viewpoint of a person who's come to economics and finance from history and a long-term perspective. One is a question asking, are markets really addicted to QE? And beyond that, and eventually, are they addicted to fiat money? I mean, the fiat money regime has been around only for 40, 45 years. And finally, why are emerging market central banks tanking up on gold? And this tanking up begins from 2005 onwards, from the time when you have had easy monetary policies under the Greenspan era. So just 3 questions. I'll just end on that, and thank you.
Thank you, Rathin, and thank you, Alok, for that very comprehensive presentation. So I will actually use the few points you made to lead off. Sense of where it stands is to go back to 2010 when Korea was the G20 president, and QE2 was initiated in October of 2010, October that year, leading to a rather stormy meeting, I think it was Busan, if I recall, where the Brazilian finance minister basically made the currency wars statement and said that the US action was actually causing damage to emerging markets. His main complaint was based on exchange rate dynamics. He felt that excess dollar liquidity was resulting in short-term inflows into emerging markets, which at that point had actually started to recover quite strongly in contrast to the advanced economy. That this was then hurting competitiveness and could derail their recoveries. The US response to this was that US monetary policy was driven exclusively by domestic considerations. The mandate of the Fed was to manage domestic unemployment and price stability, and the international consequences of this were really not part of its mandate. It's a perfectly sort of legitimate response, but they also went on to say that in fact a US recovery, which presumably QE2 was trying to achieve, was actually good for the global economy, and again one couldn't really challenge that proposition. So a healthy US economy, a recovering US economy was good for emerging markets, and so anything that was being done to achieve that should not be seen as a reason for complaint or resistance. So that went on for a while and faded out eventually. But I think one consequence of QE2, and this has been analyzed, and there was a G20 report also on commodity prices, which concluded, I think wrongly, that commodity prices are not significantly impacted by this liquidity burst. But the timing is I think too close to be entirely coincidental. We saw oil prices shooting up in late 2010 very sharply by almost $30 a barrel over a period of a few weeks, and I think that was a consequence of the liquidity infusion that QE2 created. Now, of course, one would expect that with this kind of liquidity, as Alok was demonstrating the huge expansion in the Fed's balance sheet, that the US economy itself would start to show some signs of recovery. But while there were some early signs, there was really no indication of sustainability. And so we had a QE3 in September of 2012. In between, we had the long-term refinance operations of the ECB in December of 2011. Generally, the contrast between the performance of advanced economies and of emerging markets was quite striking over those 2 years, where the former were sluggish despite all of these liquidity infusions, and the latter were actually showing fairly strong signs of recovery. That is, of course, turned around now. I think one can debate whether QE3 was necessary or not, whether it had any impact or not, but I will skip that issue. Move from 2010 to 2013, when I suppose it's ironic that countries that complained about QE2 were the ones that were perhaps hardest hit by the Fed's announcement that it would actually roll QE back. The turbulence that we saw from May till September of 2013 was, I think, unprecedented in many ways. You look at the variations in exchange rates and capital flows and all of that. Very long-lived also, almost 4 or 5 months. Of course, exacerbated by Syria and oil and a variety of other factors that were going on at the same time. But by September, when things looked like they were melting down, the announcement in September of September 18th, I think was the date, that the Fed actually wasn't going to immediately taper, obviously contributed an enormous amount of stability to the financial markets. And when the taper actually began, I think in December that year, markets were amazingly and surprisingly calm. So the announcement of the taper did seem to have an enormous and very adverse impact on currencies and financial markets in general in the emerging economies. But the actual execution of the taper did not. So a number of issues I think we need to try and understand why did the emerging economy currency and financial markets react the way they did, both with the introduction of the QE, particularly QE2. QE1 was in the heat of the crisis, and why did they react the way they did to the announcement and the execution? I think the basic complaint of the emerging markets in 2010 was valid, in the sense that they did see, or they did legitimately fear the disruptive impact of very short-term capital flows. I think one thing that we have to recognize is that this liquidity infusion actually changed the distribution of time horizons in investment quite significantly, and we moved from somewhat of a balance between short-term and long-term horizons to very much towards the short end of the spectrum. And so investment came and went with great ease. Any shock, external or domestic, in any economy would tend to cause large amounts of capital movement, and currencies became excessive or relatively more volatile than before. And that was certainly a cost to bear, particularly in countries where hedging against currency risk was not very easy, either not accessible at all or quite expensive to do. So the real impacts of these movements, I think, were also quite significant. But at the same time, the longer-term prospects for emerging markets are eventually, directly or indirectly, tied in with US, certainly, and perhaps the combination of US and European performance. And the Fed argument then that the quicker we get the US economy back on track, the better off the rest of the world economy is going to be, was also quite compelling, quite persuasive. The question was, one, the costs were certain and immediate, as always in any reform or change process, the benefits were somewhat further away and somewhat uncertain. There was no guarantee that QE2 was going to cause any recovery or stimulate a recovery in the US economy. So the two costs, exchange rate volatility and the composition of capital flows on the one hand, and two, the impact on commodity prices, particularly oil, I think were very, very significant in the post-QE2 phase. Coming to QE3, why did capital flows react the way they did to the announcement of the taper? And if you look at it from an expectations viewpoint, there was no question at any point through this process that sooner or later QE2 or QE would have to be unwound. There was never any signal or any anticipation that this was a permanent arrangement. So why did markets not build into their calculations, or investors not build into their calculations, the certainty, not even the probability, but the certainty of a rollback? And if that had been done, would turbulence have been less in the aftermath of the announcement? I think the key issue here comes back to the composition of capital flows in terms of horizons. The shorter the investment horizon, the more skittish it is, the more extreme the reaction to shocks, as I've already said. And so my hypothesis as to why the markets reacted so violently to the May 22nd announcement by Bernanke is that we had an excess, a very large, almost overwhelming percentage of global capital flows in very short horizon investments. So safety, flight to safety, whatever you call it, better to cut and run than to wait and see what happens. Exit costs are relatively low when you have that short horizon. And that's what happened. I think eventually we, over those 3 or 4 months, saw all of the short-term capital, or much of it, exiting. I think there's some evidence to support that. Even from the Indian situation, I saw an analysis that suggested that investment that had come in at an earlier stage actually didn't exit during this period. Well, that's one piece of evidence. Whether it is entirely persuasive or not, I don't know. But the facts of the situation seem consistent with this horizon explanation, which is that if you put in money with a day or a week in mind, you're going to get out when there is any prospect of huge turbulence, and in fact that then tends to reinforce the turbulence. Why did the markets not react so violently to the actual execution of the taper in December? I think December 2013 was the first month when a $10 billion reduction was made. Partly because the composition of investment had changed. It had moved back to a more balanced portfolio, long-term, short-term. Partly because all of the countries that had suffered enormously had actually started to put in place significant measures, short-term, long-term, whatever, to bring their vulnerability down. And in the Indian case, it was essentially the current account deficit and the various measures on gold and some other things which actually brought down that deficit very, very quickly. So when the shock actually hit, as opposed to the anticipation of the shock, the vulnerability simply wasn't as large as it had been earlier, and that therefore did not translate into the kind of turbulence that we'd seen earlier. So that's, to me, the broad underpinnings of the QE dynamic over these 4 or 5 years. And as we look ahead, what are we going to see? Alok has already pointed out some risks going forward, the pivot and the impact that it might have on global markets in particular, whether this will be the cause of another major bout of turbulence. I think we have to look at 2 potentially stabilizing factors here, because so much of this turbulence has already happened, And I don't really see the future as simply a replication of the past, because I think a lot of it's a bit of a release of pressure that happened in 2013, and I think the situation has changed fundamentally since then. Two factors. One, as I said, the composition of capital flows, I believe, has normalized to a very significant extent. Short-term money is certainly still very much in play, but as the monthly decrement of $10 billion takes place, I think the percentage of short-term money in global capital flows is starting to shrink. We're again seeing this in the form of dollar dynamics. You see the dollar has been appreciating quite steadily for quite some time, which essentially means that money is going back into US instruments, short-term money exiting from emerging markets and going back. And two, commodity prices, including oil now, have moderated quite significantly over the last few months. Oil, Brent is now at 102 or so, and it's not been there for quite some time. We saw it peaking out at 116 in August of, exactly a year ago, in August of 2013. And that was when, of course, the rupee was also at its lowest point, 68. But after having stabilized around 110 for several months, it's now at 102. We don't know whether this is temporary or permanent, but I do think that there is some impact of the withdrawal of QE. And the third factor, which goes back to the Fed argument in 2010, is that the US economy looks like it is in a much more sustainable recovery mode. So just as we can anticipate certain threats from the withdrawal of QE in terms of potential instability, the whole addiction argument that Alok put across, I think we can also see some signs of forces of stability at work. And these are the three that I want to emphasize. The composition of capital flows, the softening of commodity prices, and the greater sort of prospect of sustainability in the US recovery. Thank you.
Thanks, Subir. Bang on time. Thank you.
Thank you very much, Mr. Chairman, and let me first of all thank the organizers, ICRIER and the Konrad Adenauer Foundation for inviting me to Delhi. It's a pleasure to be back. And as every year, we have to discuss very serious issues of international economic cooperation and the future of the of international financial markets. This morning we have heard, I think, already two convincing presentations on monetary policy and the potential change of monetary policy. I would like to add a few comments from a German perspective. I'm not tempted to say from a European perspective, because as you are well aware, perspectives within Europe differ sharply these days. And what I would like to add is a critical view of what monetary policy has been achieving in recent years. It is, of course, difficult to calculate the effects of monetary policy as long as we are still in the middle of a historic experiment. It's too early to tell whether this will, at the end of the day, result in a benign outcome or whether it will result in a worst-case scenario in the loss of credibility of fiat money. This is what you mentioned in your last paper. It's, I think the jury is still out. We can say a few things, and I'll try to make a few comments in that regard. I will not look at the at QE as defined by the Bank of England. I will look primarily at the effects of this ultra-low interest rate policy and what a change would result in if we go back to higher interest rates. To come back to this German perspective, in my country, the impatience with the extremely loose monetary policy is growing. There is increasing criticism with regard to the to the monetary policy implemented not only by the European Central Bank, but also, of course, by the Fed and the Bank of England. Many observers in my country are asking, where is all that liquidity going? Where is all that firefighting water going? And what does it, where does it cause kind of damage, unwanted damage? The question essentially is the damage that is caused by too much liquidity greater than the utility of that liquidity? And here we don't have a defined answer. What we do know, however, this is of course a political economy perspective, what we do know that some people are benefiting from this monetary policy and others are paying the bill. We have seen the cartoon by Alok with that cash flow cow, which clearly said, which clearly identified the beneficiaries of the policy and which also identified those that are paying the bill. In Europe, I'm afraid, we are combining the worst of several worlds. We are bailing out banks, and the US is doing that in a similar way with QE. But in contrast to the United States, in Europe we are failing to close banks. The US does both. The US is providing liquidity, but it does at the same time and continues to close banks that are not viable. And in Europe, I'm afraid, we have an inflationary use of the term systemically relevant. Every little bank that hitherto you hadn't heard of is declaring itself systemically relevant, and policymakers are responding to those claims and are keeping those banks alive. This is a dangerous development in not only my view. We unlearn the utility of crises for the sustainability of a capitalist system. From time to time, capitalism needs a crisis to get rid of unsustainable businesses, and at the moment we are keeping too many banks alive. When it comes to the question of whether central banks, whether monetary policy should consider the side effects of the ample provision of liquidity, we have, of course, a debate today, but we had a debate some 10, 12 years ago between then Federal Reserve Chairman Alan Greenspan and the then Chief Economist of the European Central Bank, Ottmar Issing, and they were discussing what financial stability means. What is financial stability? And Ottmar Issing was suggesting that asset price inflation should be an issue for monetary policy. He suggested that monetary policy should keep an eye on asset price inflation, not just on headline inflation. And Greenspan, of course, said this is not an issue for monetary policy. We ignore asset price inflations. This is not part of our mandate. We don't look at that. What happened in the event is that Greenspan did respond, and the Fed did respond, but it only responded when the bubble burst, which results in, I think, what could be called an asymmetric monetary policy, ignoring the asset price inflations, but acting when the bubble bursts, and I think this is not sustainable policy. Issing said that 10, 12 years ago. Today we are back in the same terrain. Today we observe that there is generous provision of liquidity, and we do see quite some asset price inflations, not in resources anymore. I share the observation that resource prices have come down significantly. Western Australians will not be happy about that because the price of iron ore has halved from its peak, and also coal prices have halved in recent years. So if you take your kind of correlation seriously, one could assume that the resource prices are indicating that a departure from ultra-loose monetary policy is about to arrive, if that works. What we should consider are the negative effects of liquidity that we could have observed in the past. I just would like to remind the audience of the negative effects of ample liquidity that was flowing out of Japan in the early 1990s and was contributing, not causing, but contributing to the Asian financial crisis in 97. So too much liquidity has side effects, and we should be cautious about those negative side effects. Sooner or later, I hope, and many people in Germany hope, that sooner or later we will come back to a monetary policy which returns, and I look at interest rates again, to positive real interest rates. This is an unsustainable situation that we have today from my perspective, and also quite a few other observers in, dare I say, Northern Europe. If monetary policy returns to a kind of more sustainable path, what will happen? What are the risks that we are faced with? And some of the risks have already been pointed out quite clearly. I would like to point out what we have seen in the past, when monetary policy in the United States changed so dramatically in the late 1970s, and some of you will recall the drama that followed. In essence, what had happened was that Federal Chairman Paul Volcker turned the world into financial turmoil by raising interest rates to unprecedented levels, fighting inflation, successfully fighting inflation, but of course the side effects, the collateral damage caused by this turn in American and US monetary policy was severe. The financial crisis that hit Latin America from 1982 onwards can be traced back to the rising interest rates in the US. And the interesting point is that nobody thought that would happen. In 1980, nobody thought this could happen. People were assuming that the current monetary policy would go on forever. And I think this is one of the risks that we are faced with today. People are assuming that what we have today will go on for at least the medium term. The financial markets at the time were caught off guard. I would like to quote the chairman of Citibank, Walter Wriston, who in 1981 repeatedly said, countries don't go bankrupt. And he was right on that. And his own bank suffered severely from this misjudgment. I think we, in 2014, are confronted with at least some similarities. As said, people are not envisaging a dramatic change of policy. And the problem today seems to be that much smaller changes in monetary policy in country A have severe effects on the rest of the world. One could trace that back to a higher level of interconnectedness, which has resulted in a greater risk of contagion. And this is something that research, I think, should focus on. In contrast to conventional expectation, greater interconnectedness has not resulted in greater stability, but it has resulted in a more limited ability of certain economies, like the Indian economy 12 months ago, to withstand then relatively small changes. A small change, just a declaration in the United States was sufficient to turn markets into turmoil in India and elsewhere, and that is a problem. So what will happen if the Fed and the Bank of England will tighten next year? Of course, and it was mentioned earlier, capital will flow back there, and this will have negative effects for countries that have lower credibility and are unable to attract capital in those days. I think one should at the same time, and I've been suggesting that in my country many people are advocating a return to this kind of monetary policy, one should also point out that it will not only have negative effects, and again we have Australia